Hello, everybody. This is Paul Forchione with the Discover Options group, and I welcome you all to today's webinar, the topic being trading options on US Treasury bond futures. What I'm going to do today, for those of you who are a little new to this format, is I'm going to share my computer screen so that you can see as I work with the OptionVue software, and I will walk you through and talk you through a variety of positions using different options combinations in the 30-year Treasury bond futures market. So the first thing I'm going to do is to share my desktop, and what you should be looking at is the OptionVue software with the quotes display. What I would like each of you to do is, as I'm making the presentation, if you have any questions, feel free to type your questions into the chat window, and what I will do is periodically pause and take a look at what questions have come in and then respond to whatever is there. The reason that I've chosen to discuss the T-bond market today is because in a couple of days, on Wednesday, the Federal Open Market Committee is going to make its announcement on whether it's going to change short-term rates or not, and it's also going to issue its policy statement. It's anyone's guess, of course, as to exactly what's going to come out on Wednesday, and even more importantly, it's anyone's guess as to how the T-bond market and other markets will respond to the news. And when I say respond, what I'm really referring to is two things. How will the 30-year Treasury bond futures and options move? Will they rally? Will the bonds rally? Will they sell off? And what will happen to option implied volatility? Will it expand? Will it contract? Will it pretty much stay the same? So these are the types of considerations that need to go into any kind of a decision when it comes to structuring and trading positions. So what we can see today is that the 30-year T-bond market, the September T-bonds with the symbol ZB, right at this moment are trading at 139 and 28/32. When you're looking at the futures, you have to recognize that the convention is prices are quoted in 30 seconds of a point. A full point is equal to $1,000, and 28/32 would be 4 ticks below another full point. So the price of 139.28 is very close to the 140 level in the T-bonds. Let's pull up a price chart along with implied and statistical volatility lines superimposed to give us a perspective on what's been happening. First of all, US Treasury bond futures, represented by the bar chart that you see here, is a market that reflects long-term interest rates. When I mentioned Wednesday the Fed is going to make an announcement about short-term interest rates, you might say to yourself, well, what does that have to do with long-term interest rates? Well, it has a lot to do with it, because there is a relationship that people look at in terms of the term structure of interest rates. And when the Fed embarks on either an easing or a tightening campaign, it spills over into all different terms of interest rates. And the 30-year bonds, being the longest term, can oftentimes be very dramatically affected. The current price on Treasury bonds, right near the 140 level, represents a long-term interest rate of approximately 3.2%. So what we've seen here, which is clearly shown in the bars that you're looking at, we've had a rather steep decline in the Treasury bond futures price from close to the 149 level at the beginning of May of this year, and we've dropped all the way down as low as to the 138 level. That would be a drop of 12 bond points, or the equivalent of $12,000 on one futures contract. That's very significant. In the last few trading days, we've had the bond market recover a couple of those 12 points. We've had it recover to the upside, which is a very minor move in terms of a reduction in expected long-term rates. Now, you'll notice there's a blue line and a brown line showing here. The blue line is a measure of option implied volatility on Treasury bond options as a composite reading. Composite meaning every option on T-bonds, whether it be in the front month or the deferred month, whether we're talking about puts or calls, whether we're talking about options in the money, out of the money, or at the money, every option has its own measure of implied volatility. And what OptionVue does is it makes a rather sophisticated calculation, a weighted average of all of those individual implied volatility numbers to come up with one reading for the T-bond market itself. And that one reading today, as of this point in time, is an implied volatility of 10.4%. That's where the blue line is right now. And you can read that 10.4% on the lower part of the screen. Well, now you have to ask yourself, what does that really mean? Well, implied volatility is a measure of expectations by participants in the T-bond options market. It's a measure of what they expect volatility will be in the future for the Treasury bond futures itself. When implied volatility rises, it means that option premiums on puts and calls tend to escalate. When implied volatility drops, the option premiums tend to shrink. So what we're really trying to do here is to come up with expectations or forecasts for two things. What do we think the bond futures are going to do? Clearly, they've dropped a lot in the last 6 weeks. Are they going to continue to move lower, or are they, as we've seen in the last few sessions, going to move higher? That's one thing we need to come up with in terms of our own independent assessment. And secondly, as we look forward in time and as the market moves, what's going to happen to that blue implied volatility line? Will it continue to move up like it has in the last several weeks? Will it move sideways, or will it actually move lower? As options traders, we need to have some kind of a forecast for those two things: price direction in the futures, movement of implied volatility. And what I want to show you today is, regardless of what conclusions you come to, you can find one or more options spreads that are suitable because they will generate profits if you structure the trade in accordance with your expectations and if the market behaves in accordance with your expectations. So let's kind of go through a variety of positions. Let's see here. Okay. What I'm showing you now is the matrix for T-bond options, and we have options that expire in 5 calendar days. July options expire in 5 calendar days. July options are based on the September futures. We also have weekly T-bond options that expire in 12 calendar days. They are also based on, or their value is tied to the September futures. We've got weeklies that expire in 19 days. And then we've got the serial month, it's called, of August options that are based on September futures. They expire in 40 calendar days. And then we've got Septembers that expire in 68 days. Well, I'm going to narrow my focus to the August and the September options. The reason being, I don't really want to deal in very short-term options for a couple of reasons. You'll notice the Julys expire in 5 days, and you will see that when you look at the close to the money options, those will have the highest value. The 140 calls have a premium of 47.5 ticks. And it is important to recognize that options on T-bond futures are quoted in terms of 64ths. I mentioned the futures are quoted in 30 seconds, but the options are quoted in 64ths of a point. So 47.5 64ths is approximately 2/3 of a point. It's essentially about $670-some. And when you get further out of the money, the prices drop off very quickly. Anytime you deal in options that are this close to expiration, the value and the deltas on these options are going to move very dramatically. We don't really want to take that kind of risk. We want to deal in options that are probably in the neighborhood of 40 days away from expiration with the anticipated plan of closing them in maybe 3 weeks to a month. Close them out when they are a week to 2 weeks prior to expiration. We avoid all of the very short-term dramatic movement when they get close to expiration that way. So let's make the assumption that we first of all want to put on a trade that will benefit if T-bond options rally and if implied volatility rallies along with that move in the market. Well, there's a couple of trades that I favor for that kind of an environment. One of them is simply the following. With the futures at the 139 and 24/30 seconds, close to the 140 level, if we were to use the September call options, and if I was to buy the 142 call with a delta of 36, and if in August I were to sell the 142 call, this would be creating what is called an out-of-the-money calendar call spread. It's a calendar spread because we're selling the front month of August, buying the deferred month of September. It's an out-of-the-money calendar call spread because the strike price I'm using, the 142 call, is higher than the price of the futures. When you look near the bottom of the screen, we have a summary of the Greek variables. The delta is 4.57. It's essentially a 5 positive delta trade. The theta, the positive time decay, is close to $5 a day. And the Vega factor, which is the dollars of sensitivity of this spread to a 1 percentage point rise in implied volatility, that blue line we looked at, that's $59. So let's look at the graphic analysis, and I'll change the colors so that it's red for the various performance lines. What this is telling us is the following. I've got 4 lines on this graph. The key to these lines is in the upper left corner of the screen. The T+0 line represents today's date. The T+13 line is 13 days in the future, essentially 2 weeks from now. And the T+27 line would be 27 days from today. I'm going to focus first of all on the T+0 line. So what we're really looking at here is what's called a graphic analysis. It's a time-lapse picture that tells us how this spread will behave as the market moves up or down on the futures. It will tell us how the spread will behave as time goes by with these various timelines. And so that's really what this is. It's a time-lapse forecast of how this spread can earn profits or be vulnerable to losses. Well, since we started with a delta of plus 4.98 or 5, obviously we favor a move up in the market because a positive delta means that we are actually participating in about 5% of the move in the underlying futures. A futures trader participates in 100% of the move of the futures, but an options trader with a spread can temper that degree of movement. So if we start off with a 5 delta long position and the market rallies from its current price of, let's say, let's see what the exact price is. Let me go over here and put in the exact price, and we want to center this. So now we get the exact price of 139 and 23.5 ticks. So if we get a 1-point rally in the bonds, we're going to have a very, very tiny profit today. If we get a 2-point rally in the bonds, we're going to have a small profit as well. But we're not worried about what's going to happen today alone. We're looking 27 days in the future. That's our anticipated holding period. That's how long we want to hold this trade. It's the period over which we want to have some positive results. And you can see that in this case, the spread would earn a $337 profit if we get, over the next 27 days, a 2-point rally in the bond futures. Well, is a $337 profit attractive? The only way to answer that question is to compare it to the cost of putting the trade on. In this case, it's the margin, and that happens to be $488. So if I were to express the profit not in terms of dollars, but in terms of a return on margin, that's a 69% return in less than a month. Clearly, that's very attractive. I'll go back to the dollars of profit and loss. So if you're bullish on the bond market and you expect, in addition to the market moving higher over the next 27 days, you also expect that implied volatility will increase, you're going to get even more profits out of this trade. And that's because, look underneath the 141 apostrophe 23.5 number, look at the Vega factor. The Vega is plus 83. That means this trade will earn $83 of additional profit if implied volatility, which was currently 10.4%, I think, when we looked at the graph before. If it goes to 11.4%, that would be a 1 percentage point increase. I can put that assumption here at the left-hand side of the screen where it says volatility change. I'm adding 1%, and it added that $83 to the number that was there, and now our profit is $415, which means obviously it's even a more profitable trade. So OptionVue does definitely give you the ability to see with a graph, and not just with numbers, how your trade can perform as the market moves, as time goes by, and as implied volatility possibly changes. Now, if the market were to go the wrong way and decline in price, clearly we're going to have a loss because our long deltas will tend to hurt us. This is telling us that in 27 days, we would lose $85 if the market drops by 2 full points on the futures. However, if implied volatility were to increase as the market dropped, well, that Vega factor helps alleviate the loss, and it's almost a break-even trade at that point. So it's really a situation where you need to look at both factors, market movement and changes in implied volatility. The other thing that's noticeable with this trade, when you look at the T+0 line, then you look at the T+13, and then the T+27, you'll notice the lines get progressively further apart, further away from each other. This white space gets bigger in between them. And then from T27 to T40, it's a very big jump up. That means that the positive time decay, the positive theta factor, grows with the passage of time. And that's a good thing. I always like to structure trades with positive theta so that while I am waiting for my forecast to play out, on getting a little bit of positive return from the decay of the options. In other words, the timing on entering the trade, the timing for, in this case, a bullish move in the market, doesn't have to be that perfect. If you're right about a bullish move right away, you're going to make a little bit of money. But if you're right about a bullish move over the next 27 days, that's when you make the most money. So positive time decay is always a favorable factor for structuring of trades. Okay, now let's take a look at a different trade that would also benefit us and make profits if the market rallies and implied volatility goes up. And this is going to be a little bit more of an aggressive trade. What I'm going to show you is I'm still going to work with August and September options, but if we, in September, purchase the 142 call, at this time we're going to sell the 141 call in August. What we've done now is we've created a diagonal calendar call spread. A diagonal calendar call spread. Let's see what that looks like. Actually, let's do this a little differently. Since the price of the futures is at 139.18, let's buy a close to the money call in September with a delta of 47, and we will sell an out of the money call in the month of August, a 142. That's actually a better bullish position because it's 18 deltas long, earns positive time decay, and has a large vega factor. This is a more aggressive position for a bullish position compared to the trade we looked at. This is a modestly bullish one, the 142 traditional calendar. This being a diagonal calendar gives us more positive delta starting out, gives us greater profits in the short run as the market rallies, and greater profits after 13 days or 27 days as the market rallies. And throughout the entire move, we have a positive vega factor, which gets higher and higher with the passage of time. So we benefit even greater with a rise in implied volatility after time goes by. So we do have a higher margin requirement. So when we look at the yield on this trade with a 2-point rally in the bond futures will come out to be 54% as compared to the yield that we had on the previous trade, which was 66%. This is a higher yield on the other trade, but it is a smaller absolute dollars of profit, $321 versus, in this case, $681. So how do you choose between these two trades if you're bullish? Well, recognize that this trade that we're looking at, the diagonal calendar spread, is a more aggressive trade because if we're wrong and the market declines, you're going to incur larger losses than on the previous trade. So what you can do with OptionVue, if you're so inclined, is you can superimpose the previous trade and get an idea as to which trade you like. It's a little confusing when you start superimposing them on top of each other, but clearly when you examine the Greek variables, namely the delta, the theta, and the vega, and you look at the shape of the curve and you anticipate where the market will move, you can get readings for the profits, you can get readings for the possible losses, and you can see the sensitivity to implied volatility. So these two trade structures, an out-of-the-money call calendar or a diagonal calendar call spread, are two good ways of playing for an anticipated bullish move with rising implied volatility. Okay, now what I want to do is shift gears and show you some other trades. There is a question here, will a double diagonal be a better trade? We'll get into the double diagonal a little bit later on in the presentation. Let's look at an assumption about a bullish move, but instead of an expectation for implied volatility rising, if the bullish move is accompanied by implied volatility dropping, there's a couple of trades that you could consider there. Let's take a look at one of them. One of them would be what's called a reverse calendar put spread, a reverse calendar put spread. So what that means is we're going to work with puts and we're going to work with the out-of-the-money puts. So if I go to August and if I buy in the front month of August the 135 put, and if I sell the September 135 put, that is a reverse calendar spread. It's positive deltas and it is negative vega. So it benefits as the market rallies and it benefits from a decrease in implied volatility because the vega factor, the dollars that you will earn, has a negative number in front of it. So if the market rallies to 141.23, we will earn $196 in 27 days because of the positive delta. And then if we get a decrease in implied volatility of, let's say, 2 percentage points, we're going to add the negative vega factor to it, a factor twice the negative vega factor, and the profits would be $321 in relation to a very low margin of 323. That's 100% return in 27 days on this one lot trade. Clearly, if a person is inclined to be targeting, let's say, $1,000 profit, well, then they'd want to do a 3-lot trade instead of a 1-lot trade. As long as you can generate a trade that looks good from a standpoint of a return on margin on a 1-lot, you can scale it to whatever size position you wish and have all of the relationships remain the same. So this would be a reverse calendar put spread for a bullish environment and declining implied volatility. There is another trade structure that you could use, and that would be a reverse diagonal calendar put spread, a reverse diagonal calendar put spread. So if we go with a close to the money, let's say 140 put in September that we buy, or sell, excuse me, and we're going to buy the front month, and we're going to buy the front month with the out of the money, let's say 138 put. Buy that one rather than sell it. Now we have a positive delta trade with a negative vega, and here's what that trade looks like. So we do benefit as the market rallies. We do benefit with the passage of time, and we have a great benefit from a decrease in implied volatility. Look at the vega factor is minus 131. So when we put in an assumption about a decline in IV, now the profits jump up quite dramatically. So here, with a 2-point rally, we're going to have more than 100% return. Of course, what you'll notice on this trade structure is we're starting out with a trade that has negative beta. It's not my favorite trade because even though you can generate nice profits with the anticipated rally, if the market stalls out and time goes by, we're going to end up losing money because the negative time decay becomes increasingly negative against us. So I'm not really that fond of the reverse diagonal calendar put spread. You can change the strikes so that you can shift this curve a little bit more to the left and start out with a little bit of positive time decay. But I prefer, when I am expecting a decline in IV with a bullish outlook, I prefer instead even a different trade structure, and that would be what is known commonly as a out-of-the-money bullish butterfly. So if we look at the August options, if we're expecting the market to move higher, what we could do is we could sell for the body of the butterfly a couple of the 142 calls. We could buy an in-the-money 138 call, And then in order to complete the butterfly, we have 138 versus 142. We go to the 146 and we buy that. We've purchased the wings, the 138 and the 146, and we've sold the body at 142. That creates a bullish directional bias with deltas. We still have a negative vega. So now as time goes on, the spread can earn a very nice profit, and it can earn even a greater profit with a decline in implied volatility. This is close to the 90-some% return. So those are three different types of strategies for a bullish orientation and a bearish implied volatility orientation. Now, of course, there's also a possibility of structuring a trade where you are bullish on the market, but you really don't want to make a forecast. You don't want to be exposed to whatever implied volatility does. And then you can create what I call a vertical put swap position, a vertical put swap. So once again, if we take a look at where the futures are, and what we want to do then is to sell a close to the money put. Let's sell the 140 put. That's bullish, obviously. We want insurance for that put so that we don't have an open-ended loss. So we buy the 134 put. That is a bull put spread. But now, if you look at the bull put spread, it certainly does, earn money as the market goes up. It earns money from the negative vega factor, but we want to earn money with a bullish move and not be exposed to implied volatility. So all we really need to do then is to do the opposite position in the month of September. We put on a vertical bear put spread in September. And this position by itself, how does that look? When you look at all four options together, the bull put spread in August, the bear put spread in September, we look at all positions together, and what have we got? We've got a bullish orientation, and we've got a vega factor that is very close to zero, whether you're talking about today or even when you're looking at 27 days in the future. The vega does tend to get a little bit positive, but not that significant, and you've already generated some very nice profits, especially when you consider the margin on this trade is extremely small. So here we're talking about a, what is that? That's like a 200% return on margin in 27 days over a pretty wide range on the upside. And even more importantly, if we're wrong and the market's going against us, our losses are very small, very small. So this is really a very attractive kind of a way of trading a directional move without being exposed to the vagaries of what implied volatility will do. So that kind of covers the bullish array of positions, a bullish outlook with rising IV, a bullish outlook with declining IV, and this one, a bullish outlook without being exposed to what implied volatility is going to do. So let's see here. I do see a question in my first example. How did I know which of the September and August 142 calls to buy and which to sell? Well, when you are structuring calendar spreads, you're always going to be selling the front month of August, and you're always going to be buying the deferred month of September. That's what's going to give you a positive vega. And I chose the 142 calls because I wanted to be bullish. So the 142 call is out of the money, which means that the delta on the September 142 call of 35 is going to be greater than the delta on the closer in month of August on the 142 call, which is 30. So that gives us a positive delta. When I'm constructing the trades, I'm always looking at the deltas of the options. I'm not really concerned about the prices of the options. I'm looking at the deltas so that I can construct the participation from a percentage standpoint, which delta is, that I really want to create. Now let's look at the situation where we are wanting to be bearish in our outlook for the futures, and we are expecting as the bonds move lower, implied volatility will rise. So you're going to recognize that what I'm going to do here is similar to what I showed you in the previous examples, but it's going to be the opposite orientation on direction. So what we can do here is we can do an out-of-the-money calendar put spread. Since the market is at 139, we could go to the 137 puts. We could sell the August 137 put, buy the September 137 put. That is a negative orientation on price, positive theta, and positive vega. So we benefit over time as the market moves lower, and we benefit as implied volatility rises because the vega factor is positive. Once again, you can earn a very attractive percentage yield in 27 days if we're right about the market moving down and implied volatility going up. It's nice to keep positions simple, and a two-legged spread is as simple as you can get, and it's in accordance with whatever your outlook happens to be. Now, if you wanted to be more aggressive, we could do a diagonal calendar put spread. So that means we could buy, for example, the 139 put in September, and we can sell the, let's say, the 137 put in August. This is a diagonal calendar put spread because we're short the front month, long the deferred month, and we're using different strike prices. The delta on the deferred month September is larger than the delta on the front month August. So we are 16 deltas short starting out. We immediately make profits on the way down with the futures. The positive time decay builds the profits. And, of course, the positive vega factor would mean that as IV goes up, we add that positive vega factor to the P&L line, and we can earn, you know, a decent, in this case, about a 50% or 45% return on margin with a 2-point drop in 27 days. And, of course, a bigger drop leads to bigger profits in this kind of a situation. So the degree that you are bearish will determine exactly what strike prices you choose and exactly how wide you want your diagonal to be. A less aggressive diagonal spread would be this one, the 139, 138. So now we're not looking for a big move down, but we're going to make the most money if it drops down by 3 points. This is about the most here. I would not suggest and not recommend that you, if you get to the point where you've earned, say, $446 or even more because implied volatility went your way, if you earned $525, take the profit. Don't try to hold it for the remaining 13 days between the T27 and T40 to try to go for an $800 profit or even a $1,200 profit over here, because what could happen is the market may continue to rally, and then you're going to start giving back the profits that you've already earned. Instead of earning your $525 and taking it off the table, any rally up to this level, even by expiration, is going to wind up giving back some of those profits. So there's a point at which you have to be willing to accept a reasonable dollar return and a reasonable return on margin and not be too greedy. That's the idea of closing the trade prior to expiration, in this case 27 days, which is 13 days or 2 weeks before expiration. And that's the reason why I like to work with options where I'm dealing with options approximately 40 days away from expiration and not working with these weeklies that are too close in. Now, we could be doing these trades with September versus maybe December, but you'll notice December open interest is very, very meager on the T-bond options. They're a long time away. They're way in the future. When these August options go away, we're going to get October options to go with the September. So it could be September and October spread that you do. But right now, we're in the sweet spot, so to speak, because we've got August versus September spreads to work with. Okay, let's see if there's some other questions here. Historically, on average, when there's a decline in the price of bonds, is the volatility going up or down? Okay, well, that's a good question, and there's a couple of ways of answering that. OptionVue does give us the ability to go to this model function here, this model button. And when we say model volatility, and we go to model volatility settings, you see this section here that says CEV factor 1.010. CEV is an abbreviation for constant elasticity of volatility. It is a number that is supposed to express the relationship of movement in the futures versus movement in implied volatility. When the number is essentially 1, which this is, it's telling us there is no direct or inverse correlation. When the bonds move up, implied volatility may move up, it may move down, it may stay constant. When bonds move down, it's telling us the same thing. Implied volatility can do anything. If the CEV factor, however, is much lower than 1, it tells us there's an inverse relationship. When the bonds rally, IV goes down. When the bonds decline, IV goes up. That's if the CEV was less than 1. And if it was higher than 1, like 1.2, and you will find some commodities have a CEV of like 1.2, 1.3, then there is a direct correlation. A rally in the underlying commodity will be accompanied by a rally in implied volatility. A decline in the commodity will be accompanied by a drop in IV. But now, having said all of that, the best thing to do is to look at OptionVue's price and volatility chart, and you can get a pretty good idea how things are behaving presently. Clearly, we've had a big drop over the last 6 weeks in price, and what has happened? We've had a very modest increase in IV, which is a little bit of an inverse correlation. So over these last 6 weeks, you might say that maybe the CEV over the last 6 weeks would be more like 0.9, something like that. And here we had a period of a month and a half or almost 2 months where the market rallied from March to the beginning of May. What happened to IV? It just drifted a little bit lower, a very, very small negative correlation. So you can see that the blue line for bonds doesn't really move around a huge amount compared to some commodities where you're going to get some very dramatic moves. So implied volatility changes in bonds are somewhat tempered. Okay, let's move on. And if we're going to be bearish on the bond market and we expect IV is going to drop along with it, well, the best trade, in my opinion, is doing an out-of-the-money put butterfly. Out-of-the-money put butterfly. So here we have the bonds at 139. If we think they're going to drop, we can sell a couple of the 137 puts. We can buy maybe the in-the-money 141 put. That's one of the wings. We've got a 4-point difference in strikes, so we'll go 4 points to the 133 put. And now we've got a 13 negative delta butterfly with the wings at the 133 level and the 141 level, the body at the 137. And when we look at the graphic analysis, clearly we're going to make money if the market drops, and we're going to make money from the negative Vega factor if implied volatility drops. So you can make some very nice profits in the neighborhood of 100% on margin in less than a month's time if we're right on our forecast for both price movement and a decline in implied volatility. And of course, all the trades I'm showing you are all trades that have absolute limited risk. It's very important, in my opinion, as an off-the-floor retail trader to make sure that all of your short options are covered by a long option. And that way you do cap how much money you can lose even in the most extreme of circumstances. Let me show you if we are now bearish and we don't even want to be exposed to what implied volatility is going to do. If you don't want to be exposed to IV swings, use this strategy that I call a vertical swap. But since we're bearish, we want to do a vertical call swap. We want to look at where the market is at. we want to sell, for example, the close to the money call, the 47 delta in this case. We would want to buy, for example, the out of the money call. That is our credit call spread that is bearish, but it does have a negative Vega factor. We want to get rid of that negative Vega factor, so we do the exact opposite in the deferred month of September, just in terms of buying and selling. Now look what the Vega factor does at the bottom of the screen. It gets very close to 0. It's like only -4. We do have a bearish outlook, a very modest bearish outlook, so that we can make money as the market moves lower. We can even actually make money if the market goes a little bit higher. This probably isn't enough of a bearish outlook. If you really do want to make money on the downside, then what you'd want to do is perhaps sell the 139 call, purchase the 139 in September, and then we're a little bit more bearish, and we do have the ability to make a little bit more money on the way down. And you will see that as the market moves presently with the T+0 line, the Vega factor is very close to 0. As time goes by, it does tend to get a little bit positive, but not significantly, and the profits have already started to build regardless of that. So even if implied volatility went down a little bit, there's still going to be some decent profits. If implied volatility goes up, that adds to the profits a little bit. But the vertical swap strategy with calls when you're bearish, with puts when you're bullish, is the best way to negate the factor of Vega in how your spreads will perform. Okay, let me close those. Okay, let's see here. From high, but here the commissions will take a lot of money. Well, you know, the commissions are a function of what your brokerage firm charges, and if you use a discount broker or an online broker, I should say, like Interactive Brokers or Thinkorswim, commissions are very, very insignificant. They're only a couple of dollars an option, so it really doesn't take much of your profits away at all. Let's see, what about the EFT, the symbol TFT rather than the futures? Well, if you're going to be trading ETFs, which the TFT is, ETFs, we're not really dealing in commodity options, because we're dealing in commodity options now where the underlying contract is T-bonds, which are very big in size. The underlying contract is $140,000. You're getting a lot of bang for your buck because the options have decent premium. When you go to an ETF like the TLT or the TBT and you try to do comparable trades, you're going to see that these are such small contracts that the time decay that can work in your favor is so minuscule that it's not going to work out very much. Let's see here. I might even be able to give you a quick example. Let me see if I can find it here. Okay, here's the TLT. I'll pull that one up. You've got plenty of open interest on the options, but now when you start looking at the values of these options, let's say that we wanted to do a butterfly that was bullish, and TLT is 113. So if we wanted to sell a couple of the August 116 calls, we're going to buy the 113 call, and then we're going to sell the 119 or buy the 119 call. That's our butterfly. The numbers here are so small that there is almost no money to be made. The margin's $100. You can make $26 to 30-some dollars. It's too small. The underlying contract, in other words, is too small for these ETF contracts. You want a large underlying contract so that the options will have adequate dollar value to make these spreads look attractive. Okay, I don't want to run out of time, so I want to show you the other aspect to this, which is what if you're not bullish or bearish? What if you're neutral on the bond market and you want to put on some trades? If you're neutral and you think IV will tend to rise as time goes on, well, the simple strategy is nothing more complicated than a at-the-money calendar spread. You go with the at-the-money strike, the 140 strike. You can do it with puts or calls. It doesn't matter. And when you do that, you get a trade that earns positive time decay. It's delta neutral starting out, and it benefits from a rise in IV because of the positive Vega factor. And you can make a very good return as long as the market doesn't trend too much to the upside or trend too much to the downside. So nothing more complicated than an at-the-money calendar spread if you are neutral on the market and think IV will rise. Clearly that means that if you are neutral on the market and you think IV will drop, you could do a reverse calendar spread where you buy the front month and sell the deferred month. The problem with this, of course, is that time works against you. It's never good to have negative time decay if you can avoid that. So this is an undesirable trade structure in my opinion. Instead, if you want to benefit from a neutral market with IV dropping, then do an at-the-money iron butterfly. Sell the at-the-money 140 call, sell the at-the-money 140 put. Now buy insurance on both pieces. Buy, for example, the 146 call, 6 points out of the money from the call. Buy the at-the-money or buy the out-of-the-money 134 put, 6 points away. That's a pretty close to neutral trade with positive time decay and a negative Vega, which is what you want. You want a neutral market with a negative Vega, and you can make a boatload of money on this if the market cooperates and if Vega goes down. You can make way more than 100% return on your money over a pretty decent range. So an at-the-money iron butterfly is really a great trade for that environment. And then what if you wanted a neutral position and you didn't even want to have any kind of a bet on the Vega factor on implied volatility? Well, then what you can do is instead of this trade that we just looked at, which is an iron butterfly, let's take the insurance pieces and instead of putting them in the same month of August where we're short the August at-the-money 140 put and call, let's buy our insurance in the next month out in September. And that means that we would be buying something like a 146 call. And in order to make the position neutral, we'd be buying the 135 put, because now in September, these long out-of-the-money options will negate the deltas and the Vega from the short August options. So when we look at the whole position, it has a similar looking graph, but you'll notice the Vega factor is very small, minus 35, and as time goes by, the Vega factor basically gets very close to zero. So we're taking out the sensitivity of changes in implied volatility from how the spread will perform, and it's simply a function of positive time decay and market movement. If we're right about the market not moving too much, and if time goes by, we'll make a decent profit. Because look at the margin on this trade. It's extremely small, only $175. We're talking about potential profits much more than that over a pretty wide range. So this strategy is called this is a straddle in August, and this is a strangle in September. So that would be a strangle swap. And if you were to put on a strangle swap, then instead of having the at-the-money short 140 call and 140 put, we could sell the out-of-the-money 141 call. We could sell the out-of-the-money 139 put, and then we have a strangle in August, and we have a strangle in September, and it truly is still a neutral position, and that would be a strangle swap. It has more of a flat top at the expiration line as compared to the straddle versus strangle swap that we looked at a moment ago. But it's still essentially the same type of situation where we are looking for positive time decay over a range of prices in either direction with little impact from implied volatility. So that would be the way to play for a neutral outlook without being exposed to changes in option premiums. So I've kind of run through the full gamut: bullish, bearish, neutral, IV up, IV down, no impact from IV. And you can work with these trade structures in virtually any commodity market that is relatively large in size. It's not going, these spreads are not going to look that good when you're dealing in low-priced stock options or ETFs because they just aren't big enough. That's the beauty of working with commodity options. And the other thing is commodity options also offer you the advantage of having low margin requirements as compared to margins on stock options. The regulators, for whatever reason, have given some, I don't know what word to use, dispensation for commodity options trading so that with lower margins, you can really get some very good potential bang for your buck in relation to doing the same types of spreads with stock options. So let's see here. I did want to mention, which I may have mentioned in passing, some other things relating to what I call important considerations when you are structuring your options trades. And just to run through them very briefly, I would say number one, you want to make your trades, structure your options trades based not only on what you think the underlying commodity is going to do in terms of direction, but definitely look carefully at how your trades will behave with respect to implied volatility changes and time decay. You really want to make your trades have positive time decay. Otherwise, the timing on entering the trade is going to be very, very critical, and negative time decay can cause losses. Number two, money management is very important. I've shown you low margin trades, but regardless of the trades that you do, low margin, moderate margin, high margin, money management dictates that you do not be hesitant to take losses. Not all trades are going to make money, no matter how good your graphic analysis looks, no matter how good you think your forecasting is. Never be reluctant to take losses. And never underestimate the impact of how margin requirements may change as the market moves and as time goes by. All of the trades I showed you today had low margins. Those margins will tend to increase if the trade loses money, if the market moves in an unfavorable direction, if implied volatility goes the wrong way, causing losses, the margin on the trade will increase. So you always want to give yourself room for excess margin in your account. Another thing is it's very, very important to analyze your trades using a program like OptionVue, where you are looking at how these trades can perform as time goes by, and don't focus only on how they can perform at expiration. The plan is not to hold these trades to expiration. The plan is to close them before expiration and to avoid all of the unpredictable short-term impact that happens with options close to expiration. And lastly, it almost doesn't even, I mean, it's so obvious, but make your own trading decisions and don't rely on the decisions of others. No matter whether you're watching CNBC and listening to these supposed experts coming up with their forecasts on what's going to happen, remember there's two sides to every coin, and even the experts are often wrong. Sometimes they're wrong more often than they're right. Doesn't mean that they can't make money, and it doesn't mean that you can't make money. You just have to make sure that you make your own decisions and that you manage your losses, and the profits will basically take care of themselves. So let's see here. I don't see any other questions. I think that we've probably covered the full gamut. I know we ran through them rather quickly. The only thing I guess I would like to add is the following. Let me pull up the chat window here, and I'm going to give you my email address. If any of you happen to have questions, you can feel free to email me. I'd be happy to try to help. And in addition, I want you to be aware of the fact that I do have a website, and this is it, let's see here, theaceprogram.com, where I have a lot of educational material on options, a lot of free webinars, a lot of other webinars that I do charge for, but a lot of educational material in the way of books, DVDs, and I offer mentoring and coaching as well. So take a look at that if you haven't. And also, this webinar is or has been recorded, is being recorded, and it will be available shortly on the OptionVue.com website. And when you go to that OptionVue.com website, there will be, right on the front page, a link that says archive of previous webinars. So you'll be able to find this one and many other ones, so you can listen to them at your leisure. There it is. Jim put up the link for the OptionVue videos on the webinars. So thank you all very much for participating, and I wish you the very best in your trading endeavors.